Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra. With me is Pavitra Parekh and you're watching MF Corner. Well, we did write to you and we did ask you for your queries and we did get a lot of them. So just goes on to show how interested people are in the mutual fund space. Some of them are already investing and some of them are looking to invest in mutual funds. So good time to get all of these queries sorted and solved by our expert today.
All right, so let's welcome her on the show now. We are joined by Prableen Bajpai, founder at Finfix Research and Analytics, to answer all of the queries that you guys have sent in. Prableen, it's always a pleasure having you on. So thanks for joining us today. You know, like Sonal was mentioning, we've received a lot of queries. So let me just get straight to it. The first one comes in from Suraj Kumar, who writes in from Bengaluru. And he wants to know about mutual funds that exclusively invest in treasury bills of specific time periods. So government bills essentially of 90 days or 180 days. And he's asking what you would recommend here.
All right. Good afternoon, Pavitra, and good afternoon, Sonal. Great to be here. Government, of course, borrows, and those borrowings are divided into short-term and long-term. So in the short-term borrowings, Pavitra, we have the T-bills, which are issued by the RBI for durations of 91 days, 182 and 364 days. Typically, within mutual fund categories such as liquid funds and the ultra-short duration funds invest in treasury bills. They do have exposure, but it's not the only component of those categories or schemes. Here, Suraj will have to probably settle for a scheme which has a higher allocation towards treasury bills. Typically, they are somewhere between 25 to 40% in majority of the liquid funds. For certain liquid funds like Prableen Parekh, we have it as high as 78 to 80% exposure to treasury bills. So I think Suraj will have to go and see if he is comfortable with that allocation to treasury bills, but no exclusive products. Having said that, for longer duration, purely government securities, we do have the passive debt funds, with maturities of 2030, 2032. So for long-term exposure, he can look at those.
Okay, all right. So this is a space which is slightly more difficult to understand. So thank you for making sense of that, Prableen. Rohit is writing to us from Pune. He says he's been investing in Axis Blue Chip and FlexiCap funds since 2020. This was at a time when Nifty was around those 10,000 levels. And now look at it, we are near the 21,000, 22,000 levels. He wants to know what are the future prospects of his investments and asks whether he should exit or remain invested. Prableen, what's your take here?
Right, Sonal. Again, Axis funds, a lot of questions regarding, whether investors should keep holding or exit these different funds. So firstly, that these two funds, of course, follow a growth strategy typically, which was followed by Axis as a fund house. And these two funds also have a high overlap because as a flexi cap, also they have a high exposure towards the large caps and the other is a large cap fund itself. So typically since 2021 onwards, 22, when we saw the rate hikes, any growth strategy fund has been severely impacted. And that includes not just Axis, but even fund houses like UTI, PGIM, which have been typically following a growth strategy. Now, having said that, because his allocation seems to be not too high, I would say that because he's kept these funds through a very difficult phase of 2022, 23, I think he can now wait for the rate cuts to come into play, and also some sort of movement in the large cap space itself. What we've seen is that during this time period, large caps, as we know, have been lagging, and it's been the mid caps and the small caps which have actually outperformed. And within those large caps, also the allocations to both these funds were majorly in HDFC Bank, Infosys, Avenue Supermarts, Bajaj Finance, which typically haven't moved. So I think because he's been so patient with them, perhaps another 6 to 8 months, if we are looking at the interest rate cut, there can be some sort of positive movement here, and then maybe he can be exiting at a better level.
Okay, got that. That makes sense. And that is the word that we've been getting from all our experts as well, that maybe this is a time to be increasing allocation to large caps. Or, well, if you're in it, then stay put for now. The next query comes in from Rahul Khanna. He writes to us from MP and he's asking which type of schemes are best for systematic withdrawal plans without losing corpus. Prableen, what would you recommend for a systematic withdrawal plan?
Systematic withdrawal plan, Pavitra, I think is a great tool, to manage your cash flows, take money out of a scheme. And I feel here what we are wanting to do is park our corpus in a fund where we don't see too much volatility, and during drawdowns, there is less erosion in the value of the fund. So multi-asset funds, balanced advantage funds are two of the preferred categories. Other than that, I feel large caps can also be used if he already has exposure to large caps. And, on the question of how fast and at what pace should he be withdrawing so that there is no depletion, would ideally depend at what withdrawal rate, is set for the fund. So, for example, I'm just giving an example here. For an annual withdrawal of 10 lakhs, somebody is wanting, and that has to be inflation adjusted, the person would require a corpus of about 2 crores. And if you're looking at a 10% growth in the fund, this corpus can survive for almost 3 decades. So withdrawal here is at 10 lakhs a year is around 5%, but it's inflation adjusted. So there has to be a gap between the growth and the withdrawal rate. And with a 2 crore corpus, 30-year period can be managed if withdrawal is lesser. So there has to be a gap there.
Okay, all right. So with that, we'll move on to the next query. Mayur Sharma is writing to us from Ahmedabad and asks if the Nifty index fund will outperform mid-cap funds in the long term. Also asks what should be the ideal allocation if one is looking to invest in index and mid-cap funds. That's an ongoing debate anyway, especially for this year after the outperformance that we've seen in the mid-cap index. Prableen, what do you suggest? He's not asking for this year, of course, for a longer term period. So what would you suggest?
Sonal, I think mid caps and large caps both are a very, very crucial component of an overall mutual fund portfolio. And we can look at returns from 3 different angles here to give him a better perspective. Number one is if we look at the trailing returns for the last 10 years, Nifty 50 has given us about 13% returns, and Nifty 150, which is the mid-cap index, has given about 21% returns on a trailing basis. And in fact, the mid-cap index has given more than the category average itself in the mid-cap space, which was about 20%. Now, because rolling returns are a better way to analyze any category or scheme, if we look at 3-year rolling returns over a 10-year period, that is from 2014 to 2024 January, we see that Nifty 50 gave rolling returns of about 12.74, and the mid-cap index gave rolling returns of about 16.5%. Again, beating the category also, which was at about 15%. So again, the mid-caps have outperformed. And even if we look at the SIP returns, so a 10-year SIP that was in Nifty 50 and 150, we see 13.5% returns for Nifty 50 and about 20% returns for the mid-cap index. So even if he's picking a Nifty 50 fund, what he's looking at, it must be complemented with a mid-cap, and if not an actively managed fund, even a mid-cap index fund, I think can work great. So it has to be a combination of the two, because there will be times when there is a drawdown, the mid-caps can fall much more. So ideally, I think these two will make the core of his portfolio, and together they should be at least 60% of his overall portfolio.
Okay, got that, and that is very helpful data as well. The next query comes in from Harshit Anand, who's writing into us from Pune, and from Patna, and he asks if a balanced aggressive investor should have a hybrid fund that invests in non-equities, or is plain equity investing the better choice, considering that he has an 8 to 10 year kind of horizon. He's also asking which is the better large cap fund among Nippon, ICICI or Canara.
So for Harshit, the first part first, Pavitra, that whether he should go in for a hybrid aggressive category or the large cap space, or if the hybrid category is required. So if we just pick a comparison with how large caps have been, typically the rolling returns for aggressive hybrid category has been around 11.5%, and that for the large cap space has been about 12.5%. But if we look at the standard deviation or the volatility, for example, I'll pick SBI Blue Chip here. The volatility standard deviation has been about 12.5%. And for the aggressive hybrid fund that they have, the volatility has been about 9.5%. So the hybrid aggressive category is, I think, good for those who are looking at a large cap exposure, but wanting lesser volatility. But if it's a long-term portfolio, it is a category which can be skipped, and pure large cap fund can work as well. And on the question of which of the three large cap funds for his portfolio, I think all the three large cap active funds that he's picked are actually quite good. They've given almost comparable returns on rolling return basis for a 3-year rolling return, and have actually beaten the category average. But if you look at the periods of drawdowns, I think Canara Robeco is slightly better on containing the losses. But I think the choice should depend on which other funds he has in his portfolio, and there should be no concentration of the same fund house. But any of these three, I think, can work very well for his portfolio.
Okay, all right. Prableen, that has been very helpful, but we have to get into a quick break. When we come back on the other side, we'll continue to answer all the queries that you have written in with. Welcome back. You're still tuned into MF Corner. We have with us Prableen Bajpai, and she's answering all the mutual fund queries. And the next query is actually on the phone line. So we do have a live caller with us. Neela is on the line from Tamil Nadu with an investment query. Please go on and tell us what your query is.
Yeah, this is Neela. I'm 24 years old. Recently started earning. I have a surplus of 50K per month that I would like to invest for next 20 years for my retirement. As of now, I don't have, and I don't know any short-term goals. So planning for retirement, please advise suitable mutual funds for starting SIPs.
Okay, first of all, Neela, I would like to congratulate you. You're starting investing very early with a surplus of 50,000. So that's really great. And you are thinking long term. So that's really the way to go about a lot of things generally. Prableen, what would you suggest, Neela, with the surplus that she has? How should she go about investing?
Yeah, absolutely, Sonal. So lovely to see young investors wanting to, especially plan for goals like retirement. So with a 50,000 SIP, if you are looking overall, at portfolio returns of about 12%, Neela can actually create a corpus of 5 crores for herself in the next 20 years. The creation should be with a mix of active and passive strategies, because I think as we move, into the future, and because it's a 20-year period, I think passives will also play a very important role in the overall portfolio. So I think in the large cap and the mid cap space, she can pick a passive fund. A small cap can be added from the active category, and it can be complemented with a multi-cap or a flexi-cap fund. So about 4 funds are good enough, and she can continue with that. And if she's currently having expenses of about 50,000 per month, by the time she retires, that monthly expense would become about 1.6 lakhs a month, and which would require her to have an overall corpus of about 7.7 crores. So 5 crores she'll able to generate from this SIP. But Sonal, here she'll require a step up of about 7% to reach the target corpus. And because she's very young, she should review her goal as well, every 2 years probably, as of now. And of course, more closely, beyond about 35 years of age, to assess how close she is to her retirement corpus.
Okay, got that. Neela, I hope that helps you, as you start on this investment journey, and all the best. Like we were pointing out, it's a great thing that you're starting so early on. Let's move on to our next query as well. We have K. Kapadia, who writes to us from Mumbai. Now, he has made investments in the Mirae Asset Large Cap Fund, the Kotak Flexi Cap Fund, as well as the HDFC Hybrid Equity Fund. He says that he's been investing money in these funds all the way since 2021, and the returns have not been very good. So he wants to know the future prospects of these investments, and also whether he should be moving some money or, consider any other funds. Prableen, actually all of these funds have a big large cap tilt. So, would you suggest moving some money, and also within the large cap space, are these good options? Because the returns haven't been too great.
So, yeah, too great is very subjective, Pavitra, actually. So they have actually in the last, few months or 1 year now done well. 2022 wasn't that great. All these 3 category funds gave returns from 1.6% to 5% to about just 8% in 2022. But 2023 was decent for all the 3 funds. They gave returns from the, about 18 to 20, 25% returns in 2023. So one reason why they haven't performed, of course, like you mentioned, there's a large cap tilt, and we saw large caps actually not perform that well during the last year. Only it was, towards the last 2 months that there was some movement. At this stage, I would say that this portfolio can be continued, considering that there is a higher potential for large caps to perform well in the current year. But from a long-term perspective, definitely, there has to be allocation towards the mid-cap and the small caps as well. So the portfolio is not very balanced, I would say. Gradually, some allocations have to be taken towards the mid-cap and small cap. And I think the ideal way would be to do it through SIPs, so that, the market volatility can be utilized to, his benefit.
Okay, all right. So, so many people have written into us, and looks like this time is really short to answer all of them. So we do have one more query, Prableen. I think it is the last one as well. Ananya Anand is writing to us from Lucknow. She says she wants to make a lump sum investment in mutual funds for a period of 7 to 8 years. She asked, given the overvalued market right now, should she invest in equity savings and then invest during corrections in the next 1 to 3 years? She already also adds that she already has an equity portfolio with regular SIPs going on as of now.
Always a tough call to make, Sonal, at such market levels. But I would say it would depend on the scheme that she's going to pick. So if it's a large cap oriented scheme, I would say yes, definitely certain amount of portfolio, amount can be put right away, the investment amount, and the remaining can be done in a staggered manner. Even if it's a small cap and a mid cap, partially some amount can be done as lump sum. but the percentage would become smaller. So for example, if it's a large cap, she can put about 60% in one go. If it's a mid cap, then maybe about 30% in one go. And if it's a small cap, maybe 10 to 15% in one go, and remaining in a staggered manner. I think that can be an approach that she can take. But I think the final decision would actually depend on the particular scheme that she's going to invest into, because the sectoral allocations and the current positioning of the portfolio becomes very important to take that call.
Okay, got that. Prableen, thanks a lot for joining us and helping us with all of these many queries that have come in. I'm sure it's been helpful to all of our viewers as well. But with that, we're going to wind down on this edition of MF Corner. Thank you very much for tuning in. We have closing bell up on the other side.